Silver plunged to $55, while Asian markets lost $1 trillion. The setup for Monday is now live. Right now, a number is sitting on every trading screen in the world, and almost no one watching it understands what it actually means. $55. That is where silver closed. A number that should have been impossible just days ago. At the very same hour, Asian markets lost more than $1 trillion in a single session. Not over a week, not over a month. One session. And somewhere between those two numbers, there is a connection that no headline this week has been willing to name. Because what is being reported is not what is actually happening. There is a reason this is colliding right now. And there is a reason it will not stay quiet by Monday. What you're about to see is not a recap of what already happened. It is the part nobody has shown you yet. The part that decides what happens next. The home for those who refuse to be surprised by the markets, only informed by them. Now, before we go any further, I want to ask you for something, just one small thing. If you are the kind of person who likes to know what is coming before everyone else does, the kind of person who has lived long enough to know that the news is rarely the full story, then do an old friend a favor. Press that subscribe button. It costs you nothing, but it means everything to this channel. And while you are at it, tell us in the comments, where in the world are you watching this from today? We would love to know who is sitting with us as this story unfolds. Now, let's get into it. By Tuesday afternoon, the number on every trading screen read $55. Silver, an asset that had spent the better part of a year climbing toward triple digits, had fallen hard. Traders watched it happen in real time. Analysts scrambled to explain it. And within hours, financial media around the world had settled on a single sentence to describe what had just occurred. They said the same thing was happening in Asia. Markets across the region lost more than $1 trillion in value within a matter of hours. Circuit breakers triggered. Trading desks went quiet. For most viewers watching the headlines scroll past, it looked like one story. 2 crashes, one cause, one tidy explanation that fit neatly into a 30-second segment. The explanation being repeated everywhere was simple. A peace deal in the Middle East had reduced fear in the markets. Less fear meant less demand for safe haven assets like silver. Less demand meant lower prices. It sounded logical. It sounded complete. And it was being said with enough confidence that almost nobody thought to question it. But somebody did question it, and what they found did not match the story being told. While headlines were celebrating peace, a container ship was struck by a drone in the Strait of Hormuz. Not a rumor, not a forecast. An actual strike on an actual vessel in one of the most important shipping corridors on Earth. Within hours, the United Nations suspended an escort operation. It had only just begun protecting ships passing through that same stretch of water. Warnings had been broadcast to sailors beforehand, telling them that safe passage was conditional, not guaranteed. This was the detail that did not fit the official story. A market that truly believed peace had arrived would not behave this way. A shipping lane that was genuinely safe would not need warnings broadcast to its captains. Something was being described as resolved while it was, in reality, still unfolding. This is the moment where the real investigation begins. Not with the price of silver, not with the size of the loss in Asia, but with a simple, uncomfortable question. If the peace deal did not cause this, then what did? The answer, it turns out, is not one event. It is 4. 4 separate forces operating in completely different parts of the world for completely different reasons, all converging in the same handful of days. Each one pushed the same direction. Each one added weight to the same scale. And because they all landed together, it became easy, almost irresistible, for analysts to mistake coincidence for cause and wrap it all into one clean narrative. That narrative was wrong, not because the events did not happen, but because the explanation skipped the part that actually mattered. Here is what makes this moment different from an ordinary market dip. 3 of the 4 forces behind this collapse carry an expiration date. They are tied to calendars, to policy statements already made, to financial mechanics that run their course and then stop. By the time markets open again, their pressure will already be fading, whether or not anyone notices. The 4th force does not behave the same way. It is not tied to a calendar. It is not finished delivering its effect. If anything, it is still building, still developing, still capable of changing the picture entirely before the next trading session even begins. This is the distinction that almost nobody watching the headlines this week was given. They were told a story about peace. They were shown a price. They were left to assume the two were connected, and that the matter was now settled. It was not settled. It was, and remains, very much in motion. What follows is not a retelling of what already happened. The price is known. The losses are known. What is not known, what has not been explained anywhere else, is how 4 unrelated forces lined up in the same narrow window of time, why 3 of them are already losing strength, and why the 4th is the one variable serious decision makers should be watching closely as the next trading session approaches. To understand why silver fell the way it did, one must start somewhere far from the metals market entirely. inside a central bank meeting room where a single sentence changed the mood of global finance. A new chair had recently taken the seat at the head of that table. His first major policy statement was being watched closely, and when it arrived, it carried more weight than most analysts had prepared for. Interest rates were held steady. That part was expected. What was not expected was a quiet but deliberate change in language. A phrase suggesting future rate cuts was simply removed from the statement. No drama, no raised voice, just an absence of words that used to be there and markets noticed immediately. Behind that one missing phrase sat a harder problem. Inflation data released the same week showed prices rising faster than the central bank's own target allowed. The institution responsible for controlling inflation was now operating with a policy rate sitting below the very inflation it was supposed to be managing. That is not a comfortable position for any central bank to be in, and traders understood exactly what it implied. Borrowing costs were likely to stay higher for longer, perhaps even climb further before they came down. This single shift mattered enormously for an asset like silver. Silver pays no interest. It generates no yield. Its appeal rises when the cost of holding cash or bonds is falling, and its appeal fades when that cost is rising. And when real yields move higher and a currency strengthens at the same time, automated trading systems built around these relationships respond instantly. They do not pause to consider mining output or industrial demand. They simply see the yield signal change and reduce exposure to non-yielding assets like silver, often within the same trading session. This explains real pressure on the price, but it does not explain the size of the move because this particular signal was not new. The central bank had been hinting at this posture for more than a week already. The inflation number, when it finally landed, matched what most forecasters had already expected. There was no shock left in it. A force that relies on surprise to move markets loses strength once the surprise is gone. And by the time silver dropped to $55, this particular driver had already said most of what it had to say. So something else had to be doing the rest of the damage. And the second force came from a place almost nobody connected to silver at all, a regulatory decision in an Asian financial market involving semiconductor companies. Weeks earlier, regulators in that market had approved a new category of leveraged investment products tied to two of the world's largest chip manufacturers. These products allowed everyday retail investors to amplify their bets on an industry riding in an extraordinary wave of enthusiasm around artificial intelligence. Demand for these products was intense. Retail accounts piled in as the broader stock index climbed to record highs. Then the regulator who had approved those products said publicly that he regretted the decision. That single comment was enough to trigger panic. Margin calls fired across thousands of accounts simultaneously. The two chip stocks at the center of these products fell sharply in a single session, wiping out an enormous amount of value in hours. Circuit breakers activated more than once that day, pausing trading to slow the bleeding. When forced selling like this begins, it rarely stays contained to where it started. Investors and funds facing margin calls do not sell only the asset that caused the problem. They sell whatever can be sold quickly, in any market, at any hour, to raise cash fast. Silver fits that description almost perfectly. It is one of the most liquid commodities on Earth, tradable around the clock across multiple time zones. It had absolutely nothing to do with chip stocks or Asian leverage products, yet it became a convenient source of liquidity for desks scrambling to cover losses elsewhere. Like the monetary policy shock, this liquidation event carries a built-in expiration. Forced selling driven by margin calls and portfolio rebalancing tends to exhaust itself once the underlying accounts are settled and once institutional calendars reach their quarter-end deadlines. When that deadline passes, the selling pressure tied to it does not gradually fade. It tends to disappear almost overnight because the mechanical reason for it no longer exists. Two forces down. Two of the four pieces explained. Both real, both painful, and both according to the calendar alone already running out of road. What remains is a third force built on an assumption the market has not fully tested, and a fourth force that refuses to behave like the others at all. The third force behind the collapse did not come from a trading desk or a regulator's statement. It came from the oil market, and at first glance, it told a story that seemed to support everything the headlines were already saying. Crude oil had fallen sharply over the previous 2 months, dropping from well above $100 a barrel to the low 70s. A decline of that size, in that short a window, is rarely subtle. Markets read it as confirmation. If oil was falling that fast, the thinking went, it could only mean one thing. The geopolitical risk that had been pushing energy prices higher for months was finally clearing. The strait was open, shipping was safe, the danger had passed. This single interpretation did more to drag silver lower than almost any other piece of the story. Geopolitical fear had been one of the pillars supporting precious metals all year. If that fear was genuinely gone, then part of silver's value proposition was gone with it. Every dollar oil dropped seemed to confirm the peace narrative a little further, and every confirmation gave traders one more reason to sell. But an assumption is only as strong as the evidence behind it, and the evidence on the ground told a very different story than the one being priced into oil. The drone strike on a cargo vessel had already happened by this point. The shipping escort meant to protect vessels through that same corridor had already been suspended. Warnings to ship captains were still being broadcast. Vessels were still being ordered to alter course under threat. None of this resembles a situation that has been resolved. It resembles a situation that is still active, still dangerous, and still capable of escalating without warning. Oil's sharp decline was not proof that the risk had disappeared. It was, more likely, a market closing its eyes during a calm afternoon and assuming the storm had already passed. This is where the investigation moves away from prices on a screen and into something far more concrete: the physical market for silver itself. Every futures contract for silver represents a promise that, under the right conditions, the holder can demand actual physical metal in exchange for that paper claim. Most of the time, very few holders ever ask for delivery. They simply trade the paper back and forth. But the relationship between how much physical metal sits in approved vaults and how many paper contracts could legally demand that metal tells its own story, separate from whatever the daily price is doing. At the moment silver's price was collapsing on paper, the vaults told a tighter story. The amount of metal sitting ready for delivery had not kept pace with the number of contracts that could, in theory, call for it. Industrial buyers, the companies that actually need physical silver for manufacturing, not for speculation, had spent months building supply chains during a period of shipping disruption. Their need for real metal did not vanish the moment a ceasefire was announced. Factories do not stop needing material because a headline changed. And in one of the world's largest physical silver trading hubs, buyers were doing something that should have caught far more attention than it did. They were paying a price meaningfully higher than what the paper market was quoting, just to secure real physical metal. That is not how a market behaves when it believes a price is fair. That is how a market behaves when the people who actually need the product believe the paper price is wrong. This divergence, a falling paper price sitting beside a rising physical premium, does not happen by accident. It happens when two very different groups are making two very different bets. One side is trading fear, momentum, and forced liquidation. The other side is trading necessity. History does not always favor the side with the loudest headlines. It tends to favor the side holding the actual metal. You said, now move to the final part. 600 words. After three forces have been examined, a pattern becomes clear. Each one was real. Each one moved the price. And each one, by its very nature, was always going to be temporary. A central bank statement gets absorbed by the market within days. A forced liquidation event burns through the accounts it affected and then stops. A misread signal from the oil market corrects itself once new information arrives. None of these forces had anything to do with whether silver, as a physical commodity, was actually in short supply. So the question worth asking is simple. What did not change during this entire episode? The answer is the deficit. For several consecutive years now, the amount of silver being mined and recycled has fallen short of the amount the world actually consumes. That gap did not close because a regulator in Asia made a statement he regretted. It did not close because a central bank removed a phrase from its policy statement. It did not close because oil fell 2 months in a row. The deficit is a function of mining output, industrial consumption, and recycling rates, none of which move because of a single week's headlines. Industrial demand tells the same story. The manufacturers who rely on silver for its conductivity and durability did not cancel their orders because stock markets in Asia had a difficult session. Engineers building components for solar panels, electric vehicles, and semiconductors do not check daily price charts before placing purchase orders. They check their production schedules. Those schedules did not change. This is the structural case, and it sits underneath all four of the forces discussed so far, completely unaffected by any of them. Major financial institutions appear to agree. Several large research desks have published price targets for silver well above where it now sits, with some projecting levels nearly double the current price by the end of the year. These are not retail forecasts built on enthusiasm. They are institutional models built on supply data, demand trends, and delivery mechanics, the same fundamentals that did not move during the week's turmoil. There's also a historical lens worth applying here. The relationship between gold's price and silver's price has, for decades, tended to sit within a fairly stable range. When that relationship stretches far beyond its normal boundaries, it has, on prior occasions, corrected sharply rather than gradually. The current stretch is deeper than either of the two most significant examples from recent decades. In both of those earlier cases, the correction that followed was not modest. History does not guarantee a repeat. It does, however, offer a pattern worth respecting. None of this is a prediction. It is a framework for separating what is structural from what is temporary, and for watching the right indicators rather than reacting to the loudest headline. Three measurable factors deserve attention as the next trading session approaches: the behavior of oil prices, particularly whether they reflect a corridor that is genuinely calm or one that is quietly still under threat; the level of physical metal sitting in approved delivery vaults, compared against how many contracts could legally demand that metal; and the direction of the currency that has been mechanically pressuring metals lower for weeks. These three signals will not predict the future with certainty, but they will tell a more honest story than the one repeated across financial media this week. A story built on a single convenient sentence, while the real picture remained, all along, far more complicated.